Sylvia Jablonski, before we talk about different ways to short the market using ETFs, the first thing I want to know is why you'd want to be negative against the market, because it's up around 6% so far this year, that's the S&P, and the S&P is up around 3% since Brexit, so why be negative?
Well, as you said, the S&P is at all-time highs. We're pretty much sitting here in the middle of what seems to be an 8-year bull market, and a lot of our clients worry, and we at Direxion worry that it can't last forever, right? So we essentially think that it's time to prepare and think about the future.
All right, well, one way that you can do that through a Direxion inverse ETF is the SPDN. This is the Direxion Daily S&P 500 Bear ETF. It's down around 4% year to date, but one thing I want to find out first is the S&P is up 6%. So what am I missing there?
Well, I think one of the misconceptions about daily rebalanced ETF products is that they perform a multiple of the index over a period of time. But the word daily is in the name of the fund for a reason. They're meant to track the daily inverse performance of the underlying index. So while inverse funds decay a lot less than 2 beta and 3 beta funds, there is a daily rebalance that does have some level of compounding impact in range-bound volatile markets. And we've seen a little bit of volatility in the S&P. Now we're sort of at all-time low with vol, but around Brexit we saw some choppiness, and that does affect the ETF because of the daily rebalance mechanism.
All right, and that's a one-times inverse play.
Yes.
If you want to get really negative on developed markets, there's a 3-times out there, and that's the DPK. This is the Direxion Daily Developed Market Bear inverse ETF. It's leveraged, so it's down around 15% so far year to date. So you got to be careful with this one.
Right. Again, year to date, you're talking about range-bound volatility. So since Brexit had a big impact on the Eurozone, and we saw a lot of clients flood into DPK. And it's a great short-term tactical way to express a bearish view on European markets. And we think that, that trade might continue. It's a good trade to look at. We expect a stimulus, we expect poor earnings, we expect a rough and choppy economy in the Eurozone in general. And DPK is a great way to hedge a portfolio short-term or to express a bearish view.
And if you want to dive into a particular sector, so for example, the energy sector, if you want to be bearish on that, is the ERYY. Now this is the Direxion Daily Energy Bear, and this is one times. And it was working pretty poorly because energy was coming back through the spring. You just launched this in April, but lately with oil moving down, it's been moving up. Talk about the ERYY.
Right, so ERYY, like SPDN, it's another awesome product. It's a very cheap, cost-efficient way to take a bearish view or to hedge a portfolio. And why energy specifically? Some of the geopolitical issues that we've seen around oil are starting to lift. Nigeria is stabilizing. We see oil supplies at all-time highs again. Some of those issues are gone, and we think that there might be a reversion to a downward trend in oil, which is essentially related and highly correlated to the energy sector. So it's a great way to express a bearish view on that sector or to hedge some of your long-term single equity positions, whether in oil or different energy companies.
All right, well, thanks a lot, Sylvia.
Thank you.
And thank you for watching The Street.